Silver just gave up yesterday's massive gains and dropped back to $79. But here's the twist. We're still sitting on one of the most volatile runs in precious metals history, and what happens next could define your entire 2026 trading strategy. Tuesday, February 10th, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. So let's talk about what just happened in the silver market, because this is not your typical pullback. As of today's close, silver is trading at $79.93 per ounce. Now, if you were watching yesterday, you saw silver close at $83.49, which represented a 7.07% gain from the previous session. That was a huge move, and it had a lot of people asking whether we'd finally found a bottom after the carnage we witnessed over the past couple of weeks. Well, today's 4.3% drop is telling us that the market is still very much in price discovery mode, and we haven't found that stable footing just yet. But here's where this gets really interesting, and why I think everyone watching this needs to understand the full context of what's happening. Just 12 days ago, on January 29th, silver hit an all-time record high of $121 per ounce. Think about that for a second. We went from $121 to where we are now at just under $80 in less than 2 weeks. That's a 34% decline from the peak in a matter of days. This is the kind of volatility that we typically associate with cryptocurrencies or meme stocks, not with precious metals that are supposed to be stable stores of value. The sell-off has been so severe that we've essentially erased nearly half of the value from that peak. And yet, despite all of this chaos, silver is still up 160% compared to where it was trading this time last year. Let that sink in for a moment. We're in the middle of what feels like a crash, people are panicking, and yet anyone who bought silver a year ago is still sitting on gains that most investors would dream about in a normal year. So what's driving this insane volatility? Well, yesterday's rally wasn't just a random bounce. We saw a combination of factors that pushed silver up over 7% in a single session. There was actually a 10% single-day jump, followed by a 5% rise in the sessions leading up to yesterday, which represented one of the strongest recovery attempts we've seen since the sell-off began. The market was responding to several developments all happening at once. We had news out of Japan where Prime Minister Sanae Takaichi's ruling coalition secured a landslide election victory, and that strengthened expectations for expansionary fiscal policy in one of the world's largest economies. When major economies signal they're going to open the monetary spigots, precious metals tend to benefit because investors start looking for inflation hedges and safe haven assets. At the same time, we're seeing easing inflation expectations here in the United States, softer real yields, and a weaker dollar, all of which create a more favorable environment for precious metals to rally. But today's reversal tells us that the market isn't ready to commit to a sustained move higher just yet. Part of this hesitation comes from some pretty significant commentary we got from U.S. Treasury Secretary Scott Bessent, who directly attributed the extreme swings in precious metals to Chinese traders. He described the recent top as a speculative blow-off, essentially saying that what we witnessed at $121 wasn't driven by fundamentals, but by speculation run amok. Now, whether you agree with that assessment or not, it does raise important questions about the nature of this rally and what portion of it was driven by genuine supply and demand dynamics versus pure speculation and momentum trading. Let's dig into the fundamentals for a minute, because this is where things get really compelling, regardless of the short-term price action. Silver is currently experiencing its 5th consecutive year of structural supply deficits. That means for 5 years running, the world has been consuming more silver than miners have been able to pull out of the ground. This isn't a temporary imbalance. This is an entrenched structural problem that can't be fixed overnight. You can't just flip a switch and produce more silver. New mines take years to develop, and existing mines are facing declining ore grades and rising production costs. Meanwhile, demand continues to climb, particularly from the industrial side. And when I say industrial demand, I'm not just talking about traditional uses. We're seeing silver consumption expected to surpass 200 million ounces annually by the end of this year, and a huge portion of that is coming from photovoltaic cells and solar panels. The green energy transition isn't slowing down. If anything, it's accelerating. Every solar panel that gets installed requires silver, and with governments around the world pushing renewable energy mandates, that demand is only going to increase. But it's not just solar. We're talking about electric vehicles, AI data centers that require massive amounts of infrastructure, 5G build-outs, consumer electronics, medical devices, the list goes on. Silver is becoming increasingly critical to the technologies that are defining our future, and that creates a level of demand that's very different from investment demand, because industrial users need silver regardless of the price. Speaking of investment demand, the numbers here are equally fascinating. Year-to-date in 2026, we've seen inflows into silver-backed ETFs reach around 130 million ounces. That's pushed total holdings to roughly 844 million ounces, which represents an 18% increase. So even as prices have been crashing from those record highs, institutional money has been flowing into silver. That tells you something important about how sophisticated investors are viewing this market. They're not panicking out at the first sign of trouble. They're actually using the volatility to accumulate positions at what they perceive to be better prices. Now let's talk about China for a second, because there's a development here that hasn't gotten enough attention in my opinion. Reports are indicating that China has reclassified silver as a strategic material. If true, and if China starts treating silver the way it treats rare earth elements or other strategic commodities, that could have profound implications for global supply dynamics. China already plays an enormous role in the solar industry, and if they're viewing silver through a strategic lens rather than just a commodity lens, that could lead to stockpiling, export restrictions, or other policies that tighten available supply for the rest of the world. So with all of these fundamental factors supporting higher prices over the long term, why are we seeing such brutal short-term volatility? This is where the speculation angle comes into play. When Treasury Secretary Besant pointed to Chinese traders and called the top a speculative blow-off, he was highlighting something that actually does show up in the data. The speed of the move from $80 to $121 and then back down wasn't consistent with normal market behavior. These kinds of parabolic moves followed by violent reversals are the hallmark of markets that have become disconnected from fundamentals, at least temporarily. Leverage, algorithmic trading, momentum chasers, stop-loss cascades, all of these factors can create price action that has very little to do with actual supply and demand for physical silver. But here's the thing. Speculative excess doesn't invalidate the underlying fundamentals. It just creates opportunities and risks depending on your time horizon and risk tolerance. If you're a long-term investor who believes in the supply deficit story and the industrial demand growth story, then this volatility is potentially giving you better entry points than you would have had if silver had just grinded steadily higher. If you're a short-term trader, well, this is either a nightmare or a dream come true, depending on which side of these moves you've been on. So what do the experts think happens next? This is where it gets interesting because you're seeing a pretty wide range of forecasts, which tells you that there's genuine uncertainty about the path forward. UBS, one of the major investment banks, has put out a forecast saying that silver will return to the $100 threshold by next month. That's March of 2026, which is only a few weeks away. Their argument is based on the fundamental supply-demand picture and the expectation that the speculative excess has been wrung out of the market, setting up for a more sustainable move higher. On the flip side, there are short-term technical forecasts suggesting we could see another 7.89% decrease from current levels, which would take us down to around $77.08 by February 16th. That's less than a week away, so we're going to find out pretty quickly whether that forecast has any merit. Looking at the broader range of analyst scenarios for the rest of 2026, you're seeing bullish cases in the $85 to $90 range based on strong fundamentals and high industrial demand. The moderate scenario that a lot of analysts are clustering around is $70 to $80, which assumes stable demand trends and ongoing supply deficits, but not the kind of explosive upside we saw in January. And then there are some extreme bulls who are talking about 175 or even higher by year-end, though those forecasts typically rely on some combination of currency crisis, major supply disruption, or acceleration in industrial demand beyond what's currently expected. What's the right answer? Honestly, nobody knows. And anyone who tells you they know with certainty is either lying or delusional. What we can say is that the fundamentals provide a floor of support that wasn't there in previous silver rallies. The supply deficit is real, the industrial demand growth is real, and the investment flows are real. But we've also learned over the past 2 weeks that markets can overshoot in both directions, sometimes dramatically, and that fundamental support doesn't prevent painful drawdowns when sentiment shifts or when leveraged positions get liquidated. For the rest of this week, I think the key level to watch is whether we can hold above that $77 to $78 zone. If we break below that convincingly, we could see another leg down as more stop losses get triggered, and as traders who bought the bounce start to capitulate. But if we can find support here and start building a base, that would be the first real sign that we might have found a floor, and that the market is ready to digest the recent volatility and start looking forward again. The fact that we're seeing these $2 to $3 daily swings tells us that the market is still very much in flux, and it's going to take some time before we establish a new trading range. Looking out over the next few months through the rest of 2026, I think the key variables to watch are industrial demand data, particularly from the solar sector, any further commentary from central banks about monetary policy, developments in China both in terms of their strategic material policy and any economic stimulus measures, and of course the behavior of speculative traders, and whether we see another buildup of extreme positioning in either direction. The bullish case rests on the idea that industrial demand continues to exceed mine supply, that investment demand remains strong as investors seek alternatives to traditional assets, and that we don't see a significant economic slowdown that would hurt industrial consumption. The bearish case would be built around the idea that high prices ultimately lead to demand destruction as industrial users find substitutes or optimize their silver usage, that we see a major liquidation in ETF holdings, or that economic weakness reduces both investment and industrial demand simultaneously. One thing I find particularly interesting is that despite the recent volatility and the 34% drawdown from the peak, we haven't seen panic selling from the institutional side. Those ETF inflows I mentioned earlier suggest that sophisticated money is viewing this as an accumulation opportunity rather than a reason to exit the market entirely. That doesn't mean they're right. Markets can stay irrational longer than investors can stay solvent, as the saying goes, but it does provide some confidence that there are buyers willing to step in at these levels. The reality is that silver is in a unique position right now, where you have both tremendous fundamental support from the supply-demand dynamics and tremendous uncertainty from the speculative volatility we've experienced. That combination creates both opportunity and risk, and how you navigate it really depends on your individual circumstances, your time horizon, and your risk tolerance. What I can tell you is that this market deserves your attention and your respect, because it's proven over the past few weeks that it can move in ways that defy expectations, and that can either make or break trading accounts depending on how you're positioned. As we wrap up today's update, I want to hear from you in the comments. Where do you think silver is heading from here? Are you seeing this pullback as a buying opportunity, or do you think we're going to test lower levels before we find a sustainable bottom? What's your time horizon for silver? Are you thinking weeks, months, or years? The discussion in the comments is always one of the most valuable parts of these videos, because I learn from your perspectives and insights just as much as I hope you learn from the analysis I provide. If you found this breakdown helpful, do me a favor and hit that like button. It really does help the channel reach more people who are trying to navigate these markets. And of course, make sure you're subscribed because I'll be back tomorrow with Wednesday's update. And given how fast this market is moving, there's a good chance we'll have plenty of new developments to discuss. Thanks for watching, and I'll see you in the next one.